All right, so now we're going to talk about equity and how equity is accounted for. And so in this, we're going to look at the different types of shareholders that you can have and what their rights are. We're also going to differentiate between authorized, issue, and outstanding. This is an area of confusion for a lot of people, because if you look at an annual report, there'll be number of shares authorized in that, number outstanding, number issued, so we'll talk about that. We're going to look at different ways of financing, either by using bonds or convertible bonds or preferred stock. So we'll talk about what preferred stock is. We're going to look at accounting for stock splits and also stock dividends. And we're going to explain how you account for stock repurchases and other transactions that involve treasury stock. And remember, before I told you, treasury stock is stock that is held by the company. It has no value, but it's held by the company. Okay. And then we're going to look at the effect of convertible bonds or convertible securities and options and dividends on equity, what effect those have. So we're going to look at that. Okay. So corporation, usually authorized according to national or state laws, and stockholders have the right to vote, share in the profits, share in any assets once all of the creditors have been paid off in liquidation, and usually have the right to acquire more shares if the company issues more stock. So usually when a company issues more stock, it gives the existing shareholders the option to buy the stock, and that way those existing shareholders won't have their percentage of the company or their control diluted by the new issue. So usually new issues are first offered to the existing shareholders, and sometimes they're offered to existing shareholders at a bargain price, which essentially ensures that these shareholders will either buy them or sell the right to buy them at that bargain price to somebody else. Also, shareholders elect the board of directors, which we talked about on Monday, and that's how they exercise control, by electing the board of directors, who then control the company and the managers. Usually a proxy is an authority that shareholders give to have their shares voted by another party. So often you give a proxy to the brokerage or other custodian of your assets, and they vote your shares rather than you, not always. And shareholders have that preemptive right to buy any new issue of capital stock. Shareholders also have limited liability, so this is the advantage of this form of ownership. So if you're a shareholder and the business is sued or has liabilities that are greater than its assets, the creditors cannot come to you, the shareholder, for money. The most that you can lose is what you have invested in the shares. So you have limited liability. And so your personal assets are not at risk.